Hey guys, welcome back to another episode of the 365 Days of Forex series, where I'll be talking through one of the more important lessons that you need to drill into your head from day one. And of course, that is risk management. I'll also be showing you how you can go through from finding your positions on TradingView to calculating your risk using an app on your phone. So without further ado guys, let's get into today's video. So first of all guys, before we get into techniques of managing risk, when you're actually trading and calculating your position sizing, we need to take a step back and look at what actually is risk management. Risk management is essentially the process of managing the associated risks involved with trading, either at the point of complete or partial mitigation. So with that in mind, let's take a look at probably one of the most popular and most effective ways of managing your risk when trading, and that is of course by using 0.01 lots per £100 of your trading account balance. This method not only ensures you haven't got to use your brain when you're actually managing your risk, it also means it's super easy and convenient to blow your account without actually being aware that you're doing it. All jokes aside, that is an awful method of managing your risk, and if you're doing that currently, you should definitely consider subscribing and hitting the notification bell before you get a margin call from your broker. To actually manage your risk properly, a good place to start is by using the 1% risk rule. This risk rule is as simple as it sounds. It is just a rule of only trading with a maximum risk of 1% per position, which essentially means you can lose 100 consecutive trades without rebalancing of course, before blowing your trading account. You can of course actually reduce this even further, and I've personally met a lot of traders who will even use a 0.25% risk due to the lower strike rate of their strategy, which is something that is required to prevent huge periods of drawdown, which can have a massive impact on your trading psychology if you aren't used to it. Of course, it may sound simple to just use 1% of your account balance when you're in positions, but it can become pretty tricky actually to calculate what position size 1% of your account is and what it relates to when you start trading on different assets with different sized stop losses. Thankfully, an awesome app has been made by Urban Forex, which is called Stinu. You can use this app to help manage your risk for the 1% rule, or actually any percent you want for that matter. To make it easy for you to follow, I'm going to go through an example showing you how you would calculate your risk on a long position and exactly what you'd need to do. But first of all, we need to cover a couple of phrases off that you might not have heard about before. If you already know what these are and you've already done risk management before and you just want to learn how to use Stinu, then of course feel free to use the timestamps below to fast forward through. The first phrase we need to look at is risk reward ratio, which I always just shorten to R.
I lost my voice. The key to success is let the voice rest. Stay blessed.
This R ratio is a figure that represents how much you will make compared to how much you are risking. For example, if I was risking £10 to make £20, I would be taking a 2R trade. If I won that trade, I would make 2R, and if I lost the trade, I would lose R, where R in this case would be £10 or 1% if I was trading with £1,000. The second phrase that I might also reference is strike rate. This is a lot more self-explanatory than the risk reward ratio, and is simply the success rate of your strategy, which is something that could affect what percentage you allocate to each trade you take, and that'll be based on your actual trading results. Now that you have those phrases out of the way, let's head over to the computer and run through an example on TradingView. Okay, so now we're on a nice clean chart on TradingView, and today we're going to use GBPUSD to run through some example positions and how we would use Stinu to factor in the size of your position stop loss as well as your account balance to manage your position sizes properly. As we can see, we're on an hourly time frame, and I'm going to just do some classic no strategy trading here to run through some examples of finding out how large your stop loss is and how large your target is, as well as what R ratio you're on each specific trade. The first step is to head over to the sidebar. As you can see, there are both long and short position tools for taking both buy and sell trades. In this example, let's run through a buy trade, which means we'll click on the long position tool. Once you've clicked the tool, you'll see it highlights the icon, and then you can click onto the chart to place that position tool. As you can see here, I've set the position to have a 30 pip stop loss and a 90 pip target. This, if you haven't already seen on the screen, would be a 3R position, meaning that if we're using the 1% risk rule, we would make 3% if the trade goes on to hit our target, we would lose 1R if the trade goes against us and hits stop loss, which would equate to 1% loss. With these figures in mind, let's head back in front of the camera and go through how to use the app Stinu to figure out what position size we should be using now. So thanks to the beauty of video editing, instead of just having to record my phone screen with the camera, let's get a big iPhone screen right up here. Blur me out a little bit so you can follow through with the process instead of being distracted by me, and let's get cracking. Once we've opened the app, you are asked to fill in your account balance, risk percentage and stop loss size. If your balance is in dollars, you can just tap the top 3 lines and head into the settings and change this, so do not worry. For the sake of this example, let's say our account balance is £750 and we're going to use the 1% risk rule. We also know that our position on GBPUSD has a 30 pip stop loss. So once we've plugged all those numbers in, we need to select the asset that we want to trade, and we know that's GBPUSD. After that, we can simply hit calculate, and you'll be able to see the risk percentage and nominal risk value at the top of the screen, as well as the lot size, which you should be using to abide by this risk allocation, which in this case will be 0.033. However, as we know, most brokers will only allow you to trade in increments of 0.01s or mini lots, and therefore to prevent over risking, I always suggest rounding this value down instead of up. In this case, that would mean your lot size on that particular trade would be 0.03. So guys, now you know how to identify the size of your stops, targets, and R value on TradingView, and add these figures into Stinu. There's no reason why you should be messaging me on Instagram in 80% drawdown asking me for some non-advisory financial advice. But I'm sure someone will, and this is why you should smash that like button and leave a comment below telling us what risk percentage you use on your position, so that YouTube shows this video to more traders just like you and prevents another blown account. Because remember, a trading account is for life, not just for a £300 to £5,000 challenge. Cheers guys, and I will see you in the next one.